In a market plagued by volatility and economic uncertainty, SCHD stands out with its dividend yield above 4.1%, a level seen only once before during the 2020 crash. This yield now surpasses many high-yield savings accounts. Yet SCHD offers something cash cannot: dividends growing at 11.5% annually since inception. While savings account rates remain fixed, SCHD's combination of current income and growth potential creates a rare opportunity for investors seeking both safety and upside in these uncertain times. Let me show you exactly why this may be the perfect moment to add SCHD to your portfolio. The Schwab U.S. Dividend Equity ETF isn't simply another dividend fund. It's a meticulously constructed portfolio designed to balance current income with future growth. While many investors know SCHD for its attractive yield, few fully appreciate the power combination of factors that make the current entry point potentially transformative for long-term investors. SCHD tracks the Dow Jones U.S. Dividend 100 Index, focusing on quality companies with strong financial fundamentals, sustainable dividends, and competitive positions in their industries. Unlike many dividend ETFs that chase the highest yields regardless of company quality, SCHD employs a rigorous screening process that evaluates cash flow, return on equity, dividend growth, and consistent payouts. This disciplined approach has created a unique investment vehicle with nearly $70 billion in assets under management. The ETF holds 100 stocks across multiple sectors, with its top 10 holdings accounting for approximately 42% of the portfolio. These include stalwarts like Coca-Cola, PepsiCo, AbbVie, Amgen, Pfizer, Bristol-Myers Squibb, Cisco, and Texas Instruments. Companies with proven business models and long-term dividend growth. Particularly compelling at the moment is that SCHD is trading at just 17 times earnings compared to the S&P 500's price-to-earnings ratio of nearly 26. This means SCHD is approximately one-third cheaper than the broader market, providing a significant margin of safety in an environment where many analysts are concerned about overvaluation. The recent market correction has pushed SCHD down nearly 10% in just a month, creating what may be an exceptional entry point. For perspective, SCHD now trades at prices similar to what we saw in 2021, but with a critical difference: the dividend has grown substantially since then. Perhaps the most compelling reason to consider SCHD right now is its current dividend yield of over 4.1%. This is remarkable for several reasons. First, this yield level has only been seen once before in the fund's history, during the March 2020 market crash at the beginning of the COVID-19 pandemic. Throughout most of its existence, SCHD has typically yielded between 2.8% and 3.6%. The current yield represents a significant premium to its historical average of about 3.1%. Second, SCHD's yield now exceeds many high-yield savings accounts and certificates of deposit. While the best savings accounts offer around 4% with zero risk, these rates are fixed and provide no growth potential. In contrast, SCHD combines a comparable current yield with substantial upside in both dividend growth and share price appreciation. The mathematics behind this yield anomaly is fascinating. When we examine SCHD's dividend history, we can see that its most recent quarterly payment increased by 22% year over year. This continues a pattern of robust dividend growth that has averaged over 11.5% annually since inception, and an even more impressive 13% since 2018. This combination, a starting yield above 4%, coupled with double-digit dividend growth, creates a powerful compounding effect for long-term investors. Based on these metrics, a $10,000 investment today could generate approximately $410 in annual dividends initially. But if SCHD maintains even a conservative 10% dividend growth rate in just 5 years, that same investment could be yielding over $660 annually, representing a 6.6% yield on your original cost basis. Over longer periods, the compounding becomes truly extraordinary. After 10 years, your yield on cost could exceed 10%, and after 20 years, it might approach 30% of your initial investment, meaning that the initial $10,000 would be generating $3,000 in annual dividend income. And that's without accounting for reinvested dividends or additional contributions. Beyond its attractive valuation and exceptional yield, SCHD offers another compelling advantage in the current environment: stability during market volatility. As we navigate through economic uncertainties, including inflation concerns, potential recession fears, and geopolitical tensions, SCHD's portfolio construction provides a natural buffer against market turbulence. The fund has approximately 30% of its holdings in healthcare and consumer staples, sectors that typically demonstrate resilience during economic downturns. This defensive positioning has produced remarkable stability during previous market corrections. SCHD's maximum drawdown during market sell-offs has been approximately minus 21.5%, significantly less than the technology-heavy QQQ's decline of minus 32%. Even more impressive, SCHD's worst annual performance is just minus 5.56%, compared to the S&P 500's worst showing of minus 8%. This downside protection doesn't just preserve capital, it creates a mathematical advantage during recovery phases. Starting from a smaller decline means requiring less of a rebound to reach new highs. For instance, a 22% drop requires a 28% gain to break even, while a 32% drop requires a 47% gain. This mathematical reality means SCHD investors can potentially reach new highs faster when markets turn around. There's also a psychological advantage to this stability. Most investors struggle to maintain discipline during market declines, often selling at the worst possible moments. SCHD's more moderate drawdowns and continued dividend payments can provide the confidence needed to hold through turbulence or even add more shares at discounted prices. In March 2025, SCHD underwent its annual reconstruction, rebalancing its portfolio to ensure it continues to meet its quality and dividend growth objectives. This process is a key part of SCHD's long-term success strategy, as it systematically removes companies with deteriorating fundamentals or dividend policies, while adding those that demonstrate strong growth characteristics. The recent reconstruction has strengthened SCHD's future dividend growth prospects. While the average yield of the additions was slightly lower than the stocks removed, the median dividend growth rate for the new additions is substantially higher than for the removed stocks. This strategic rebalancing ensures that SCHD maintains its focus on dividend growth, not just current yield. This disciplined approach to portfolio construction separates SCHD from many other dividend ETFs. Rather than chasing the highest current yields, which can sometimes signal companies in distress, SCHD prioritizes sustainable growth in dividends, the factor that ultimately creates the most value for long-term investors. To fully appreciate SCHD's potential, it's worth comparing it to alternative investment options, including broad market ETFs like VOO, Vanguard's S&P 500 ETF, and other popular dividend ETFs. Over the past decade, SCHD has delivered an annualized return of 11.6%, slightly trailing VOO's 13.7%. However, this comparison doesn't tell the complete story. SCHD has achieved these returns with significantly less volatility and higher income. Additionally, SCHD's more defensive positioning may provide an advantage if we enter a more challenging market environment, characterized by higher interest rates and slower growth. Compared to other dividend ETFs, SCHD stands out for its balance of current yield and dividend growth. Many high-yield ETFs offer yields above 4%, but with minimal or no dividend growth. Conversely, many dividend growth ETFs offer excellent growth rates, but starting yields below 2%. SCHD's combination of a 4.1% current yield and double-digit dividend growth is truly exceptional in the ETF landscape. SCHD also compares favorably on cost structure, with an expense ratio of just 0.06%. It's one of the most cost-effective dividend ETFs available. This low-fee structure means more of your investment dollars are working for you. For perspective, an investor putting $10,000 into SCHD will pay just $6 in annual fees, compared to $40 to $80 with many actively managed dividend funds. Wall Street analysts currently rate SCHD as a moderate buy, with an average price target of $31.38, implying approximately 11.4% upside potential from current levels. This consensus view reinforces the notion that SCHD represents good value at current prices. Perhaps the most powerful aspect of SCHD's current opportunity is the potential for its dividend income to eventually replace employment income, what financial planners call the crossover point. Based on SCHD's current yield and historical dividend growth rate, we can calculate approximately how long it would take for a consistent investment strategy to reach this crossover point. For example, with a $10,000 initial investment and $500 monthly contributions, an investor with a $40,000 annual salary could potentially reach dividend income replacement in about 19 years. For those earning $60,000, the timeline extends to roughly 22 years, while $80,000 earners might need 24 years. These timelines can be significantly accelerated through increased contributions. Boosting monthly investments from $500 to $750 could cut 4 to 5 years off the journey, while $1,000 monthly might reduce the timeline by 7 to 8 years. Strategic lump sum investments, such as directing annual tax refunds or work bonuses toward SCHD, can create additional timeline jumps that bring financial independence closer. The beauty of this approach is that, unlike traditional retirement planning that relies on drawing down principal, dividend income can continue indefinitely and will likely increase over time as companies raise their payouts. This creates both financial security and the potential for building a legacy asset that can be passed to future generations. For investors convinced that now might be an opportune time to add SCHD to their portfolios, implementing a practical blueprint for success requires thoughtful planning and disciplined execution. Begin by considering your investment timeline, as SCHD is ideally suited for those with at least a 5 to 10-year horizon. The longer your perspective, the more you'll benefit from dividend growth compounding. Start with an initial investment that fits your budget, even if modest, as establishing a position you can build upon matters more than the starting point. Consistency becomes the next critical element, so set up automatic monthly or bi-weekly contributions through your brokerage platform to ensure steady accumulation regardless of market conditions. To maximize the powerful compounding effect, enable automatic dividend reinvestment, DRIP, which purchases additional shares with each dividend payment and accelerates your growth trajectory over time. When possible, enhance your returns by holding SCHD in tax-advantaged accounts like IRAs or Roth IRAs, minimizing the annual tax drag that can significantly impact long-term performance. Perhaps most importantly, commit to staying the course during inevitable market volatility, viewing price declines not as reasons to abandon your strategy, but as opportunities to acquire more shares at better values. This straightforward approach can be implemented by investors at any stage of their financial journey, with the key ingredients being consistency and time rather than a large starting amount. While SCHD presents compelling opportunities, it's important to acknowledge potential risks and considerations. First, although SCHD has demonstrated remarkable resilience during previous market downturns, it's not immune to broader market corrections. During significant sell-offs, SCHD will likely decline, albeit typically less than the broader market. Second, SCHD's sector allocation differs significantly from the S&P 500. With lower exposure to technology stocks that had driven much of the market's recent gains. If tech outperformance continues, SCHD may underperform broader market indices over shorter periods. Third, rising interest rates can potentially impact dividend-paying stocks as bonds become more competitive income investments. However, SCHD's focus on dividend growth rather than just high current yield provides some insulation against this risk. Finally, no investment strategy is universally appropriate for all investors. Individuals closer to retirement or with lower risk tolerance might consider allocating only a portion of their portfolio to SCHD, complementing it with more conservative investments. Despite these considerations, SCHD's current valuation, exceptional yield, and strong dividend growth characteristics create what may be a rare opportunity for long-term investors seeking both income and growth. As markets recover and prices potentially appreciate, the current yield advantage could quickly diminish. Have you started building your dividend income stream yet? Share your thoughts in the comments below. And don't forget to subscribe for more analysis of investment opportunities that could help secure your financial future.